Right, that is the overview of the potential of the pension sector. And right now I'm joined by Joseph Rono, who's the Group Executive Director, CPF. Welcome to the show, sir. Just for starters, looking at that particular item, the president says, there's so much appetite for government bonds right now. Coupon rates for 14%. He says we go to the market, we get above 10%, we have to rethink. How practical is that?
It's practical, but of course it's going to take time. The biggest problem why we've seen government paper rates going up is because of the high appetite for money by government. But of course, government is aware that that is not sustainable. You cannot continuously be issuing bonds at highs of 14%. It's not sustainable for the economy. So what we are likely to see is a deliberate attempt and efforts by government to bring down rates. If you may recall, I think at the height of NAC government, the rates were really very high. But over time, I think the rates came down to as low as almost 0 point for treasury bills. So that is likely to be the direction we likely to go. Those high rates is not sustainable, especially for a risk-free asset.
Yes.
You know, a risk-free asset means is a no-brainer. You just need to sit down, put money there, and then of course wait to get returns.
Yes.
So you can imagine now for an asset where you are putting some risk premium in it, how much rate will you be asking for if government securities are already giving you a high of 14%. So definitely I think I do concur with the sentiments of the president. It will get to a time when they'll come to the market, anything above 10%, they are not going to take it.
Definitely.
Yeah.
And I mean, pension funds now walks into this discussion because you are offering an alternative.
Yes.
To the government, sort of partnering with the government in funding its projects. For starters, is that particular issue of 14%. Looking at portfolio of the pensions industry, majority of it is in that secure asset that you are in.
Yeah.
So will it mean that over time we see less pension funds investing in government securities?
Yes, what we are likely to see going forward is that, pension funds, they've already locked in the 47% of the assets currently, but pension funds keep getting new monies through contribution. So what we are likely to see, especially as rates come down, we likely to see a situation where pension funds are now going for alternative investments for the new monies. And perhaps maybe some of the maturities and the new income which they are getting, which will of course over time tilt the scale towards other asset classes in the long term.
All right.
Yeah.
So it's gonna take a while. We give it a year.
Yes, perhaps a year.
Okay.
Perhaps a year we'll be able to see a major shift on that.
Okay.
Yeah.
Now, as the sector, you say. Because the government says we don't want to borrow from externally, so we have to borrow internally, and internally pension sector you have a pool of money that you can lend to the government. So far, working out the framework of how this will happen, what has been the progress?
The discussion has been going on very well. I think the head of state has come out very strongly that he will want local partners whom he can work together for purpose of rolling out national projects. So in this case, we need to start moving away from foreign denominated debt, which is really putting so much pressure on our forex, on foreign exchange. You can see where the shilling is right now, because a lot of those foreign borrowings of course comes at a very high cost, because maturities comes in, you must have those dollars for you to pay out. But at least for the case of local borrowings, that is really going to cushion the government. And the best direction to go is now what the president is talking about, which is partnership.
Yes.
Partnering with local institutions like pension funds, SACCOs, to roll out some of the government programs which they have in place. I mean, a typical example will be these concession roads which has been done in the past using foreign money. Pension funds can always chip in there to basically bankroll those kind of projects. And the good thing is that kind of borrowing will then be in local denominated currency.
Okay.
So there is no then pressure on forex on the side of government.
Okay.
Yeah.
That is quite interesting because it's also a balance in terms of lending to the government. Lending to the government, and crowding out effect that we've seen. I know that comes with the bonds, because people prefer to lend to the government. It's very secure. For pension sector, is there a space where an avenue that can be created for private sector lending or partnering apart from the government also, so that it's sort of a dual approach development-wise?
Yes, there are avenues like, for example, when you look at why is it that government borrow? They borrow for purpose of certain projects. So government have in place this PPP framework, so that can easily be activated where the private and the public sector now comes in together and undertake some of those projects which has been earmarked for PPP.
Yes.
So that will be more or less of a softer way of government executing some of its programs without necessarily burdening the balance sheet of government.
Okay.
Yeah.
An upcoming recession, we're being told 2023 will be a recession year. In terms of sort of having a soft landing, having a dollar-denominated debts, it does not help in such an environment. How do we expect the government to react? Especially, will heavy local borrowing and shilling-denominated debt be create a more manageable environment amidst global recession?
Absolutely. Because you see, during a recession, especially if it's going to be something which affects the global space, many foreign investors tend to move back to the hard currency. Which basically leaves the local currency very exposed. So you are much safer when you have a significant portion of your borrowing being denominated in local currency, because you can always manage that.
Okay.
You can always manage that, whether through tax collection. Worst case scenario, of course, you may not expect government to do that, but when you have debt in local currency, worst case scenario, you can even print money. But of course, we may not necessarily go into that direction. But what we are saying is that local denominated debt is much more manageable than foreign.
All right. Quantitative easing should be the last of options that we explore, definitely. Yes. Briefly, I know because we're going to take a short break in less than a minute. I'm thinking now about how to boost pension contributions. We are collecting, we have we're saving at 12% of the GDP, quite young. And I think pensions, you have a role, an avenue where we can utilize and boost saving for retirement, for pension, for example. I don't know, what are the low-hanging fruits that we can take advantage of as we speak?
Yes, some of the low-hanging fruits is, I think the government has been talking about aspect of a mandatory pension. But of course, even before we get into the issue of mandatory pension contribution for all employees in this country, the low-hanging fruit here is that the private sector has been, of course, encouraging people out there to save for retirement because they are occupational, they are umbrella schemes which are already available there in the market.
Yes.
But when you look at the real deal in terms of how to push the rates of the savings in the country is by putting in place a mandatory saving. A story is told of Singapore, which now has almost 3 times the GDP of Kenya, a country where we were at the same level at independence. If you look at the rate of savings in a country like Singapore, it's as high as around 34%. In fact, their pension industry size is 43% of their GDP. But look at our case, for example, we are around the value of the pension industry in Kenya is 12% of our GDP. So you can see the difference between the two economies and why Singapore has moved to the level where it is right now compared to Kenya. Okay. So it's basically the trajectory they put from the word go. Their rate of savings is very high. I think for employer it's around 14.5%. Okay. For employee is almost 20%. So their rate of savings on monthly basis, which is mandatory to any person working in Singapore, is around 34%. Yes. For us, we're doing the 200 shillings in NSSF. That is where most Kenyans are, which is very low. Yes. For the case of occupational employers, you can see most occupational employers are contributing because their employers has made it mandatory. It's not an option. Okay. So that's the direction we need to move on. Definitely, very important. And I think when you come back, I'd like us to touch on this issue of arrears, administrative, engagement that could be used to transform the pension sector. I know you guys have handled lab trust, so you have quite an experience, and we've been having court rulings here and there. You will clarify for us, but right now we take a short break right now on Business Today. Remember, the talk is pension. Are you saving for retirement? Think about that as we take the break.